Okay, so this is, I'm going to deal with two questions, but this to lead into it. These are the types of policies that are driving the bioeconomy. Achieving greenhouse gas emissions, that's one of the gating attributes of the DOE loan guarantee program. Achieving greater energy efficiencies, a lot of that has to do with grants. And integrating rural programs, the USDA programs in particular with grants and loan guarantees, stimulating economic growth, and obtaining an economically feasible conversion technologies is the end game, meaning getting your first commercial up. So here's some industry highlights. The World Energy Council report from late last year said that there's $48 trillion required in energy infrastructure between last year and 2035. So there's a lot of scope to what you're doing. This lays out where we're at with the biofuels, 14.3 billion gallons last year, 1.8 billion on biodiesel, 800 million gallons on advanced biofuels defined as in the chart there. The projection is about 180 companies producing more than 1.7 billion gallons by 2017. Another thing that's been pushed into this through the EPA is renewable CNG and LNG, which got RIN credits attributed to them, so that expands it a little bit. Here's the two things I'm addressing are what are the obstacles to growing the bioeconomy, what are the challenges, and then two, what are the solutions. So on the challenge side, it's a lack of funds at the company and the project level, and that's grants and equity and debt. The lack of certainty in the government programs, the tax incentives require extensions, and the RFS requires certainty. And the solutions are the creative financing, tax incentives, and RFS certainty. And this is a so-called valley of death. The company and project level is going from an angel round to a Series C or beyond at the top, and going from a pilot to a demo to a first commercial and beyond at the bottom at the project level. So here's an equity chart and grants. You've got a lot of people don't know about 11 buckets of grants and equity options. The federal grants, and this is all laid out extensively so you can see them in my other slides. And I lay out what's in each of the programs. Most of them are closed now, but you've got to focus on those programs for grants because those are where the new money will go on each appropriation annually. Angel funding, all of the angel fund, it's a non-dilutive funding is the grants. Angel funding, venture capital, and private equity and strategic equity and infrastructure, those are all dilutive funding. A little bit different in each one. Angel funding, you've got family offices, you've got crowdfunding along with it, and they're lesser returns than the VCs, but they want short exits. Venture capital, 3 to 7 years, double-digit returns. There's been a big pivot in that area to IT and social media, and for a while there, natural gas until the price went down. Private equity, strategic equity, and infrastructure funds, they cross over quite a bit, and they are dilutive equity also, and they have longer periods till an exit, and on the strategic equity side in particular, we're seeing that come in at an earlier stage than in the past because VCs have pivoted to other areas. State and federal green funds and international green funds, those are predominantly grants, loans, and loan guarantees. The governments don't do equity for the most part unless you get into, say, a PPP, and you see this in international settings, a public-private partnership where a government might give land to a project and they'll take a carried interest on the equity. tax equity, the ITCs, and the new market tax credits, those are on the CapEx side on your projects, and the PTCs, production tax credits and bonus depreciation, those are on the operating expense side or OPEX. Your sponsor equity has changed a bit. You've got the traditional project developers, you've got hedge funds that have come in the last 2 years, and you've got yield cos, which are traditionally build out portfolios of projects, but in this case, as a developer equity, they would acquire the portfolios and become the developer of the projects. On the portfolio equity side, you've got MLPs and REITs. Those are going to take statutory changes to make it work for this industry. I wrote the MLP bill that Chris Coons introduced, the original one, and we'll see if that can move along. But one level of taxation as opposed to two and a yield co, but you're taxed at at ordinary rates as opposed to capital gain rates, which you are at a yield co level. So those are some of the things there that you can pay attention to. Then on the debt side, you've got the loan guarantees at DOE. I spoke at length about these 2 days ago. But these are the 4 programs that are available, totaling $40 billion. Where this industry can cross over is between renewables and clean fossil, and there's $12 billion there. These are competitive programs. First commercial does not mean first commercial. It means there's not 3 or more of the existing, of the identical technology up and running in the United States. And the senior debt amounts are uncapped. You're using federal finance bank at 37.5 basis points plus a treasury spread, and I lay that out in my slides. And there's 5 fees in it. So it's not inexpensive money. On the USDA side, there's less money available, but more flexibility in that you're not getting charged the fees you do at DOE. The Farm Act brought a number of programs in, the 9003 and the 9007 in particular. The 9003 is a $250 million senior debt cap. And in the next round, there might be up to $600 million available because there was $100 million in 2014 fiscal year, $50 million in this fiscal year. So that's $150 million. And on the subsidy score, if it stays at about 4 to 1, it could be about $600 million. And so your fees are at the back end. They're 1% at closing, approximately, and 0.5% on the annual fee. This is an interim final rule, should be out sometime in May, June. 9007, $200 million in loan guarantees and $80 million in grants. Again, there's subsidy scoring to get that $200 million. It's competitive. Commercial means at least 1 year of operations, and this is a change in the final rule that was recently issued. There's $25 million on the senior debt cap, and the fees are approximately 1% on closing and 5.5% on the annual renewal fee. On the business and industry, that's competitive. That's non-competitive. It's commercial. There's more flexibility in the definition there. That there could be a change there because there's a public rulemaking on the street that we expect to see a final rule in the summer. And the fees are similar to 9003 and 9007. The definition is, as I said, is more flexible on commercial. And you can stack the 2 programs together if you need to do it. Rural utility service is really for structuring. If you've got a power plant, doesn't do fuels associated, you can get 12.5 basis points over treasuries. For 100% finance, it's a recourse finance, so you put a balance sheet up. And on the project finance side, it's the same 12.5 basis points over treasuries for the shorter of 35 years or your PPA term, and 25% equity. So watch. That's a way to help if you've got a power plant as part of your integrated biorefinery and you're getting up to the limits, you could structure that off to the side and use RUS. Other financing mechanisms, we're using AAA rated loan guarantees from the government. put it to credit enhanced non-investment grade project debt and turning it into long-term and low-cost financings. There's a new area, covered bonds. It's new in the United States, but not overseas. Traditionally, they've used pools of mortgages to credit enhance the project bonds, but you're limited to the rating on that pool of mortgages. So what's trying to be done in the United States is to use some other mechanisms like Treasury strips, which are AAA rated, and we'd get the equivalent of what we're doing with loan guarantees from the federal government over the bonds. So on the covered portion, we'd be getting about 150 to 200 basis points over Treasuries. These are some of the insurance policies that are available to help wrapping technology risk, credit enhancing senior debt. There's a European group that's looking for guinea pigs because they haven't done this before. A lot of this is flying by the seat of your pants in this valley of death area, where they would wrap the entire senior debt with an insurance policy from a AAA rated European insurance company. So watch for that. Protection on revenue streams. Let's say your EI report says you'll produce 20 million gallons a year and you produce 18. It would fill the delta with insurance so that you always meet debt service. Protections for your tax equity and price collars for feedstock and floors for offtakes. Then the last couple here. Tax incentives. You see in the top all the ones that have expired. And what do we need? We need to extend about 55 energy tax incentives on a long-term basis to build and stabilize the industries. One thing you may not know is that these industries with biorefineries back in the 78 and 80 tax acts were given ITCs at 30, well, they were 15% for infrastructure and 10% for energy, and you stack them together, so you had 25%. They were sunsetted with the 1986 Tax Act, and they never came back. So what you're seeing in the second bullet point is an attempt to bring them back. And this has been so far with the biogas industries, where they have legislation in the last session that would have to be reintroduced, that they'd get a 30% ITC if they went to fuel, not electricity, and they reduced methane emissions by at least 52%. And if you did go to electricity instead of a fuel, you could get a PTC, a production tax credit, that's a bit higher than the open loop biomass, which is 1.1 cents a kilowatt hour. You'd get 1.5 cents a kilowatt hour, so it all helps. So there's a movement there to do it, and so people in this industry with the liquid side should be trying to get it too. And then lastly is the RFS side, which you heard a lot about. EPA has been saying that they'd get the 2014 and 2015 RVOs out. They told us at ACOR last year, at a February meeting, that it would be out very shortly, and look where we're at now. The latest statements have been June of this year. But then we heard at this conference that it may be all the way to the end of the year, and they'll do these two plus the 2016. The last problem, which is really dogging the industry, is a D3 credit waiver, which is still based on an FY 2013 number of 42 cents. And what happens is the obligated parties go to Platts and OPIS, and they see that number there, and they say, this is what we'll buy it from you for, when it's really substantially above that. And so what we're trying to do with EPA right now, and we think we're going to be successful, is to get this pulled out from the RVO discussions and have them issue a written guidance where it'll lay out the new numbers at 2014 and 2015 with a formula of how to apply it, so that when you try to go in and get your long-term contract, you can lay this down in front of the obligated party and tell them, sorry, this is the way you have to buy the fuel. And what that will do will enable us to get the long-term contracts in place, which enable us to get the equity in place, which enables us to get the debt in place, which enables us to close the projects. So those are my thoughts. and I look forward to answering any questions you have. Thank you.